take the time to introduce some members of our Island Park Private Wealth team. We got Sean Ty on with us tonight, and Ryan Burge as well. So, and then the rest of the team, I think, are dialing in, but they're not on the call right now as it is. But we just wanted to welcome you on behalf of Island Park Private Wealth. So tonight's discussion is really going to be centered around three key ideas. First, our goal is to keep you informed and educated. We want you to understand what's happening in the markets, not just at a headline level that you hear on the news, but what's really going on behind the scenes and how we analyze everything going on behind the scenes. Second, we want to give you visibility into how we think about positioning your portfolios. Everything we are going to walk through tonight, whether it's market trends, economic data, or policy changes, is directly tied to how we're making decisions on your behalf. And third and lastly, we want to reinforce our process. Markets can be driven by emotions in the short term, especially when headlines are noisy, like they are right now. And they have been, and they will continue to be noisy. But we stay grounded in the fundamentals, and we want to focus on earnings, economic data, and long-term trends to guide how we invest through different environments. So you might have heard me say we have four real pillars, right? Have a plan, don't get emotional, understand taxes, and understand fees. I can't stress the emotional side. The emotions in the market is what really separates people from making money and not making money. And the less emotional you get and you stay to your long-term plan, the more money you'll make in the market. So let's go ahead and dive in and walk through what we're seeing as we head into the second quarter of 2026. So we're going to cover a couple of key themes tonight. We'll cover, as always, we'll give a recap of the market. We'll talk about this AI disruption theme that's going on in the market. We'll talk about market leadership and the rotation of what we're seeing occurring. We'll talk about U.S. economic activity. We'll talk about oil prices, something I know many of you know about and followed your whole careers. We'll talk about inflation, interest rates, fixed income. We look at the fixed income markets a lot for signs of corporate fundamental stress. And we'll talk about what we're really looking at in the fixed income markets. We'll try to tie it all into a long-term perspective, and we'll give you kind of three key themes that we're looking forward to or looking ahead in the future. So this slide here, it graphs the S&P 500 during the first quarter. And we overlay it with major economic news and political events. But here kind of are the key takeaways. The S&P 500 started the quarter at about 6,850 and rallied through the most of January, and actually briefly touching an all-time intraday high of $7,000 in the last week of January. And the rally was driven by a broadening in market participation. Small cap stocks and value stocks were leading the rally. The rally was briefly interrupted in the middle of January when the market sold off on tariff threats related to Greenland, but then again, it recovered. Again, that's some noise, but the market then recovered. In fact, the Russell 2000 hit an all-time intraday high in the latter part of January, capping a multi-week streak of outperformance of S&P 500 as investors rotated into smaller companies on optimism around Fed rate cuts and attractive valuations. And then in January, also, the Fed held the interest rates steady, and we got a new Fed chairman was nominated, Kevin Warsh, and that set the stage for a leadership transition later in the year at the Fed. At the start of February, the market turned a little volatile, and a new theme emerged. And we'll talk about this theme, but it's AI disruption. And the first week of February, we saw a sharp sell-off in the tech stocks, specifically software stocks, as investors worried that new AI tools will not only make people more productive and maybe replace jobs, but replace traditional software businesses. And that selling broadened out over the following weeks and extended beyond software into financial services, logistics, real estate services, and some other industries. And the S&P 500 fell roughly about 2.5% from its late January highs during the initial wave. It recovered then and then sold off again in the following weeks as this AI disruption theme and concerns intensified. And then later in the month, of course, the Supreme Court struck down President Trump's tariffs, removing a source of business uncertainty and briefly lifting stocks before the attention shifted to the Middle East. And that was the quarter's defining event, right? It occurred in the final days of February when the US and Israel launched military strikes on Iran, and the conflict escalated rapidly as the Strait of Hormuz was closed to commercial shipping, which disrupted roughly 20% of global oil flows. Oil price surged from the mid 60s to the high 100, nearly touching 120, or did touch $120 a barrel at the peak in March. And the S&P 500 traded lower on concerns that higher oil prices would slow economic growth and weigh on corporate profitability and earnings. And then later in the month, Iran's newly appointed supreme leader declared that the strait would remain closed, and again kept oil prices near $100 and triggered another move lower of the stock market. And then the Fed also kept rates consistent or steady for the second consecutive meeting in March. And then the market started shifting, right? It went from rate hikes to potentially started talking about rate cuts, potentially talking about rate hikes. But then in the last couple of days of March, we saw a rally as Iran signaled a willingness to end the war, and there were peace talks. They were going to happen. And then the index, anyway, finished the quarter around 6,500, or about 4.5% lower than where it started. So where it started. Whoop, let me let somebody else in here. Sorry. Make sure he's muted as well. Great. So with that, Sean, why don't you give a little talk about the AI disruption, what happened there?
Yep. Yeah, and I mean, this is no secret to anybody. Yeah, you look last year and even the year before, though all the talk has been of AI and how pervasive it is in everyday business. But what's happened really over the last 6 months is there's been this big concern in the software sector that AI is going to, essentially put some of these companies out of business. And, to us, it's a little misleading, right? What the media is saying, there are certain companies that will be disrupted by this and will be in trouble. But really what AI is and what a lot of these software companies are partners to these AI companies. And you look at the software sector, particularly since, last September, the software sector is down 30%, right? And it's really, what this chart shows on the left, just AI disruption, right? So what has that done to technology in particular? So since September, the software sector is down 30%. This isn't the first time that's happened before, right? It happened in 2022 when the Fed was increasing interest rates. That led to a 39% pullback in the technology and software sector. 2020, during COVID, there was a 26% pullback in the software sector. And then the two before that were a little previous, right? So the financial crisis in 2007 to 2009, software was down 53%. And in the dot-com bubble burst, it was down 71%. And everybody points to the dot-com burst, and that's the concern right now, right? AI is in a bubble, and this is going to lead to something bigger. We've been through this before. To me, it is a disruptive technology. It will be around forever. It's going to change the way that businesses work, but is it similar to the dot-com burst? I don't think so. To me, this reminds me a lot of 2022, really in the cybersecurity and tech sector and COVID benefactors. The drawdown there was slightly larger than it is now. It's down 39% compared to 30%. But I don't believe that this is going to lead to something bigger. The important thing to remember here, though, is on the other side of this, and 2022 is a good example, there's going to be a great opportunity, right? Because people will panic, as they always do, and a lot of these software companies are going to get sold. But on the other side of 2022, there were huge returns that came out of it. NVIDIA, for example, in 2022 was down 60%. But since then, it's up 1,500%. So some of these companies that people are talking about now will disrupt the way everyday business is done, but they will go through volatility in the public markets. And a lot of public market is subject to volatility and overreaction. But again, on the other side of that, there's a big opportunity. So, in our conversations, what we've had over the last year is that we've shifted a bit away from tech, and we'll get into that on the next slide. But, tech had been the leader in the market really since 2022 and really since 2020. But at some point, there was going to be a rotation into value. And, we had tried to get ahead of this last year, shifting some money away from some of these AI disruptors and small mid-cap stocks and higher growth stocks into more core and value stocks to protect profits coming into this year, because it had been a good 3-year stretch, and we knew it wasn't going to last forever. So, last thing on this slide, just a comparison of the software sector to the S&P and to the growth area of the market. So again, since September, you look, software is down 30%. The S&P over that same time frame is down 2%. And tech, the broader tech market, Russell 1000 growth, is down 8%. So really, it's been isolated to a select number of companies that people are concerned about, Claude or ChatGPT or or Grok will take over. But I look at it, and Claude came out over the weekend, and they said, these are the companies we're partnering with. Palo Alto Networks is one example. The stock's down 40 or 50% from its all-time high, but Claude said, this is one of our partners, that we're going to build our infrastructure on Palo Alto Networks, on CrowdStrike. It's not going to take these companies over. They're going to enable our network and enable our security. So to us, it's a little overblown. There might be some more downside ahead, just with the Fed and depending on how much they cut interest rates. But the big thing we're going to keep focus on is the longer term and really the opportunity that will come out of this on the other end. I touched on this as well, market leadership. Really what this shows is the rotation from growth over to value since September of last year. So on this chart, you can see the S&P 500 in yellow, the S&P 500 growth in blue, the S&P 500 value in black, the Russell 2000 in light blue, the equal weight S&P in gray, and then the NASDAQ in a different shade of blue. So you look at the numbers since September of last year, the equal weight S&P is up 1%, right? So you think of the S&P, it's a market cap weighted index. So the bigger companies have more of a weight. And if you look at the top 7 names in the S&P 500, they make up about 35% of the index. So if they do well, right, the index is going to do better. But if they struggle, the index will struggle as well. What the equal weight S&P 500 does is equal weight all 500 companies within the index. So rather than NVIDIA having a 7% weighting in the index, in the equal weight S&P, it has a 0.2% weighting, right? Every one of the 500 companies has an equal weighting. What's happened over the last 6 months is that the equal weight S&P 500 has outperformed the S&P 500, the market cap weighted, by about 3%. And that's somewhat unusual when you look over the last 6 years. So since 2020, and this is through the end of March, if you look at the S&P 500, it's up 64%. The equal weight S&P 500 over that same time frame is up 35%, right? So the market cap weighted index of the S&P is outperformed by 28% the equal cap weighted index. And the reason for that is those top 7 names have done so well. So since the start of 2020, the Magnificent 7 are up 197%. So those stocks led the S&P from the bottom in 2022. But what we started seeing at the end of last year was there was a rotation that occurred. So, energy has done great this year. Industrials have done great. Materials have done great. Consumer staples have held up. So there's been a rotation from technology, from software, and even from the Magnificent 7 over into value. So when you look at the Russell 1000 growth since September of last year, it's underperformed the Russell 1000 value by about 8.5%. And we think that will likely continue through at least the first 6 to 9 months of this year. We do think volatility will remain pervasive. But again, longer term, we are fans of growth. Again, over the last year or so, we've shifted portfolios a bit from growth more over to value. towards the end of the year, we're probably going to shift the other way again. But we recognize that growth led the way from 2022, and value had struggled, so we shifted things around to take advantage of that and to protect coming into this year. So again, don't lose sight of the bigger opportunity. Over a full market cycle, growth will typically outperform. AI will disrupt the market, but there's going to be volatility ahead, right? Everybody points to 2000 and 2002. Amazon was down 90%, but if you invested in it when it was down 90%, you're up 10, 15,000% since then. So there is a big opportunity on the other end of it. There's going to be volatility ahead. There's been a big rotation that's occurred, and that will likely continue to occur. But we've prepared for it and protected going into this year.
Great. So let's talk about a little bit about U.S. economic activity, right? So this slide looks at a key measure of economic activity, the ISM Purchasing Managers Index, or PMI, for both manufacturing and services sectors. So the PMI is a widely followed survey of business activity, and readings above 50 signal expansion, readings below 50 indicate contraction. And the chart tracks both measures from the beginning of 2021 through February 2026. So if you start with the services, which is the light blue line, it has remained in expansion territory for nearly the entire period. It dipped below 50 two times at the start of 2023, but services have really been the backbone of the U.S. economic growth over the past 3 years, with consumer spending on healthcare, on travel, financial services, and technology driving activity, even as other parts of the economy slowed. Now, the February 2026 reading of 56.1 was one of the strongest readings that we've had since late 2024, and the highest since July of 22. So an indication that the services economy continues to remain on solid footing. Now, the manufacturing story is totally different, right? And that's the dark blue line. And you can see that the manufacturing PMI has been in contraction for most of the past 3 years. In fact, it's spent 34 out of the prior 38 months below the 50 line in contraction mode. But the contraction really began in late 2022 when the Fed started their aggressive rate hiking cycle. And you had rising input costs and weakening global demand all weighed on the industrial sector. There was a brief touch of the 50 line in early 2025, but it was really kind of a head fake as manufacturing slipped back below 50 for another 10 months after that. And that false start is kind of an important context of what happened earlier this year. So in January, the manufacturing index rose to 52.6, and then it held again in February at 52.4. And those are the first two back-to-back months in expansion territory since late 2022. So unlike the early 25 episode, where it really barely meaningfully got above the 50 line and there was no follow-through, there's been follow-through here in the second months. So, we don't think this is a 1 month anomaly. And it could be potentially a significant development. So for the past 3 years, the U.S. economy relied or kind of rode the back of the service sector. Now, all of a sudden, we start to see service expansion, but manufacturing is also expanding, which is kind of a broadening of economic activity. And that could be positive for the overall economy. Now, the key question is, can manufacturing sustain this momentum, and will it fade like it did earlier last year? But, we're pretty optimistic. January and February were strong in manufacturing as well as strong in the services sector, which is really painting a good sign for the economy here going forward. So let's go this slide. All right. So here, oil prices, right? So I know a lot of you know a lot more about this than we do, but we're going to give you our best shot here at talking about oil prices. So this slide kind of looks at oil prices, which have surged, up to 120, like I said earlier, and stayed pretty much at $100 or thereabouts for the past month. We've seen them slip down here the past couple of days. I think we're finished at 88 today. But it all has to do with the Iran conflict and the effective closure of the Strait, right? So this chart kind of graphs WTI crude oil back to 2006, so a 20-year glimpse of what's going on. So it gives you really a longer term view of where prices stand today relative to history. The inset chart, let's see if I can do this. I don't know if you can see my pointer, but up here, the inset chart really just gives you zooms in on what happened year to date, right? And we'll talk about how quickly the move unfolded. But if you kind of focus on the longer term, you can see how oil prices have experienced several major spikes over the past 2 decades, right? WTI hit $140 per barrel in mid 2008. That's during the great financial crisis. Traded above $100 for an extended period of time from 2011 to 2014, and spiked above 110 in 2022 after Russia invaded Ukraine. And in between those events, oil experienced long stretches below $80, including dips to 40 in 2009, again in 16 and 20. But the current reading, again, this is through the end of the first quarter, at around $100 per barrel, puts oil at a high level, well, the highest level since mid 2022, and marks only really the fourth time in the past 20 years that WTI has traded near or above the $100 threshold. So now if we kind of focus on that inset chart, we'll talk about how we got here. So oil started the year around $57 a barrel and traded really in a narrow range through mid-February, gradually climbing into the 60s. And then in late February, when the conflict began and the strait got closed to commercial shipping, we saw oil prices spike, right? And the strait, we all know, is a critical choke point for the global energy market. And about 20 million barrels of oil exports per day come through that strait. So its closure represents the largest physical supply disruption since the 1970s. Now, so prices surged from mid 60s up to, like I said, 100, approached $120 in a matter of weeks, with extreme volatility along the way. You also had the International Energy Agency announce a record 400 million barrel strategic reserve release to try to help stabilize the markets. But that effect was short-lived as prices rebound. The market's message was clear. Releases can bridge on a short disruption, but can't really substitute for the reopening for the strait. So the oil prices have immediate implications for the broader economy, right? We saw gasoline prices have risen nearly $1 a gallon since late February. And that increase acts as a direct tax on consumers and businesses, and also complicates the inflation picture at a time when inflation was already running above the Fed's 2% magic number. So the key question we have around oil prices is, how long does it last? If the strait reopens in the coming weeks, prices are expected to normalize relatively quickly. And forecasters are projecting that oil prices could fall back to the 70s by mid-year. However, if the closure extends longer, that could mean prices stay elevated and could lead to rising inflation, fewer Fed cuts, and reduced consumer spending. But we see how volatile prices are, right? I mean, oil in the past couple of days has dropped to $88, even though the strait's still closed on the possibility of the war coming to an end. So it's pretty volatile. It's one of the key measures we'll continue to watch. We'll talk about this. I mean, an inflation number came out this morning. The goods inflation is a little bit higher. We'll talk about due to the oil. But again, when we created this supply presentation and put through compliance, oil was still around $100 a barrel. So we talked about oil. So what could it mean, right? It could lead to inflation, right? So let's talk about inflation. This is kind of a two-part snapshot of the inflation picture. The chart on the left graphs headline PCE and core PCE on a year-over-year basis since 2017. The chart on the right breaks that same measure down into two major components: goods prices and services prices, to show kind of where the remaining inflation pressure is coming from. The key takeaway is that the dramatic improvement in inflation from its 2022 peak has been substantial, but it's not complete, right? It's still an incomplete picture. And the reason is a combination, or really the reason is sticky services inflation. So the chart on the left kind of, again, shows you headline PCE peaked around a little near 7% in mid-2022, and the core peaked around 5.5% shortly thereafter. And both measures fell pretty steadily through 23 and 2024 as supply chains recovered and energy prices stabilized. And the progress was encouraging, right? So the descent showed, but the descent slowed noticeably in late 2024, and it's pretty much flatlined since. The January 2026 reading, again, that's the last reading we had till this morning, but I have to put these slides through compliance. The January 26 reading showed headline PCE sitting about 2%, 2.8% year over year, and core PCE. And core is big, right? Because it removes the volatile oil or energy and food sectors. And it's really what the Fed really likes to monitor. Ticked up to about 3.1% from 3% in December. So on a month over month basis, core PCE rose about 0.4% in January, which is a pretty hot print. And if you kind of analyze that out, you're looking, at a run rate near 4.5%. So if the trend holds, the 12-month number could continue to rise in the coming months. Now, let's focus on the chart on the right. And I think this is a really good chart because this explains why inflation is sticking around, right? So you see the goods inflation, which is the dark blue line, surged above 10% in early 2022, right? And it made sense, right? The supply chains were disrupted, right? And there's a shortage of things, so it drove prices up. So it drove the price of goods up. And that wave has pretty much fully resolved itself, right? Good prices spent much of 23 and 24 in outright deflation mode, falling on a year-over-year basis, and have stabilized around 1.3%. So again, it's just the rate of change year over year. So goods are increasing about 1.3%. And again, we don't want deflation, right? That's not a good thing either. So we want some kind of inflation number. So the Fed likes the 2% number. Goods inflation right now is about 1.3%. So goods really have done more than their fair share of the disinflationary work. Service inflation, which is the lighter line, you can see peaked around 6% in late 2022 and has come down much more gradually, and kind of really stalled out around 3.4% in the second half of 2025. And the January reading, again, ticked up to 3.5%. So the primary culprits of these are the relatively insensitive sectors, right? Areas that are insensitive to higher interest rates, right? So insurance premiums for employer-sponsored plan, right? Your medical insurance, medical care services, right? Your doctors and things like that, and specialized personnel services. They all remain elevated, right? And that's really what's holding inflation up. So you can see the gap between the goods and the services line in that right chart is really the Fed's dilemma, right? With goods inflation kind of normalizing, and also no longer providing a disinflationary tailwind, the burden of getting that inflation number back to 2% falls almost entirely on the services side. And that's where progress is stalled. Now, one encouraging offset we see is shelter costs, right? So rents, home costs, and things like that. They're the single largest services component, right? And we saw rents recently post one of the smallest increases month over month since early 2021. So I'm not sure if that continues, but if it does continue to normalize, it could do some of the heavy lifting of bringing inflation down. But the broader question here is, how does the Fed get the stickiness in insurance and the healthcare and some labor-intensive categories to decrease, to get some deflationary power behind it? And now we know that ongoing U.S.-Iran conflict adds another dilemma, right, or another dimension with surging oil prices, and that will add some inflationary pressures. And again, we don't have that data in these charts. That number did come out this morning, and goods inflation did surge on, basically on higher gasoline costs, higher jet fuel costs, things like that. Now, if oil prices come back down, that could be temporary. But the real big sticky thing is that services side of the equation. All right. All right, Sean, you want to jump in here on interest rates?
Yep. So why that's all important, all inflation, is because of this, right? What does the Fed do and what it's projected to do? And the old saying is don't fight the Fed. And that's been the key over the last few years. So this chart really what it's showing is the Fed funds rate since 2021. And then in the gray area on the right-hand side, you can see the Fed funds rate where it was projected to be at the end of the year in February and where it's projected to be now, which I'll explain further. But just to recap what's happened in the last 6 years, right? So after COVID, the Fed lowered interest rates to 0% and held them there until 2022. What occurred after that was one of the fastest rate hiking cycles ever, right? We went from 0% up to about 5.25% on the Fed funds rate in the span of about a year or so. And then since then, right, the Fed cut interest rates in late 2024 and then cut again 3 times last year as well. They have not cut this year, right, for the 2 meetings so far this year. And on the right-hand side, you'll see that gray shaded area. So where interest rates are right now, the Fed funds rate is, they have a target rate of 3.5 to 3.75%. So we sit at 3.64%. The dotted blue line that goes to 3.05%, that was where the Fed funds rate was projected to be at the end of February. Right? So if the market was projecting 2 to 3 interest rate cuts at the end of February. Once the conflict started in Iran and oil surged over $100 a barrel, there's been a big repricing going on with how many cuts will occur in the market. So from the end of February to the end of March, the target or the projected rate at the end of the year is 3.56%, right? So rather than two interest rate cuts occurring between now and December, the market's projecting 0. If you look at what the Fed says, they're still projecting 1 cut, so take that for what it is. But this has waned on the market pretty heavily, right? We had that big pullback during March, really the second half of February into March, and this was one of the reasons why. Why? It's been a few reasons as to why the interest rates have been projected to be cut 2 times to no times. First, obviously, the conflict that started and is continuing. The second, inflation, as James just said, has remained sticky, and now it's ticked up a bit because of the surge in oil prices, which is going to flow through to all costs. And then the third is Chairman Powell's speech last month. He gave a cautious tone and said, they're going to remain cautious on decreasing interest rates. And yes, he will probably be out next month, but it's going to be a little more complicated than a new Fed chair coming in and them lowering interest rates. So this is the big thing we're keeping an eye on. We're keeping an eye on inflation. We're keeping an eye on where interest rates are projected to go, because that's going to determine where the market goes. And the more interest rate sensitive categories, growth, software, small mid-cap growth, those are going to be affected most by this. So until we get any sort of certainty on the conflict, on oil prices, on what the Fed is going to do later in the year, the market is going to remain volatile. And again, the concern, I guess, for the market here is that if inflation remains, or if oil remains at $90 to $100 a barrel and inflation goes up, does the conversation shift to will the Fed cut? To will the Fed increase rates? And that's what the market's going through right now, and there's a bit of a repricing. So it's something to keep an eye on right now. We look at this every single month, but keep in mind, again, the Fed is projecting themselves to cut 1 rate decrease through the end of the year.
Great. So let's talk a little bit about fundamentals and credit quality, right? So I said earlier that we really take a lot of cues or keys from the credit markets. So let's look at the credit markets, and we're going to take a look at the credit markets through the lens of the high yield credit spread. And the high yield credit spread basically measures how much more lower rated companies have to pay to borrow money compared to U.S. government bonds. And it is one of the most closely watched indicators of the credit market health, right? So when spreads are tight, the market is confident in corporate health. When they widen, it signals that the market is becoming more cautious about economic outlook. So this chart graphs the high yield credit spread since 1996. And the pattern is pretty clear. Credit spread spiked during times of crisis. And the high yield credit spread widened to more than 10% during the dot-com bubble burst in 2001, and then in 2022, and surged to nearly 20% during the great financial crisis in 07-08, and approached about 9% during the COVID pandemic early in 2020. But between those episodes, you can see the spreads have generally settled in the 4 to 6% range, with a long-term median around 4.5%. So today's reading of 3.28% is well below that median, but it has been rising since the beginning of 2026. So the inset chart on the top right chart zooms in to show how the credit spreads have moved over the past 15 months. And you can see spreads really started in 2025 near cycle lows around 2.6%. They briefly spiked up to 4.6 in April around trade policy uncertainty when it rattled the markets. But the high yield spread then tightened back to the 2% range in the second half of 2025 as trade deals were announced and reached and the global economy stabilized. And it remained near those levels heading into 2026. Now, the recent widening really beginning late February, again, you're following the same theme around this U.S.-Iran conflict as that escalated and oil prices surged, and it pushed credit spreads up from 2.85% to nearly 3.5% in a matter of weeks. Now, the current spread of 3.28 is worth putting into perspective as well. It's above the cycle lows, but still well below 4.5% long-term median, and far below the 5% or higher level that historically has kind of signaled some kind of systematic credit stress. So the widening has been orderly and reflects market repricing risk in response to geopolitical uncertainty and higher oil prices, but it is not a fundamental breakdown of corporate credit quality. And I need to stress that credit quality is really good right now, right? Corporate credit quality, corporate balance sheets are in really good shape. So the key risk here is how long does this conflict last, right? I know they're talking on Thursday about peace. Who knows if it's solved there or not, but that's kind of the key question that we have. If the conflict persists and oil stays elevated, higher energy costs, could weigh on corporate margins and push spreads wider. If it's short and resolved and oil normalizes, well, history suggests spreads will tighten again relatively quickly, as they did after the tariff widening or the tariff uncertainty last spring. So we continue to watch credit spreads. It gives us kind of just a key look into what's going on in the corporate world overall. All right. So kind of we talked about the credit side. Let's talk about earnings, right? So and tie it into kind of a longer term perspective here. So this kind of slide takes a closer look at the relationship between the S&P 500's price and the earnings that underpin them, right? So it addresses a key question that investors are asking us right now. If the market is falling, are companies in trouble, right? And the chart on the left compares the quick answer is no, but the chart on the left compares the S&P 500's price level against its rolling 12 months earnings per share going back to the year 2000. And the chart on the right tracks how analysts analysts are raising estimates for 2026, right? And how they've evolved since September. So again, the chart on the left kind of shows an important a very important relationship in investing. And over the past 26 years, S&P 500 has gone up in price if earnings have gone up, right? And there's a 96% correlation. So if a company's making money, the stock price is going to go up, right? So when earnings rise, prices tend to rise. When earnings decline, as they did during 01, the recession, the great financial crisis, COVID, stock prices tend to fall with them. So what stands out about the current environment, though, is that earnings have continued to rise, even though the S&P has pulled back roughly 6.5% from its record high late in January. So on a near-term basis, we see a divergence in the two lines. And what that's telling me is the market is getting cheaper on a fundamental basis, right? So if we kind of look at forward-looking price to earnings ratios. At the end of 2025, people were willing to pay 22 times earnings for a stock. Now that number is now at 19 times. So we've seen price to earnings ratios drop. And that was at the end of the first quarter. So investors are paying less for each dollar of expected earnings in the future. So the sell-off has been driven really by a repricing of risk in response to the geopolitical environment, not a deterioration in corporate fundamentals. So we see that from the fixed income, the credit spreads, and now we're seeing it on the earnings side as well. Now the chart on the right tells a similar story, but from a different angle. It tracks the consensus earnings estimate for each quarter of 2026 over the past 6 months. So the first quarter estimate, shown in gray, the bottom line there, is mostly unchanged since September and a little bit lower since the start of 2026. But the stability is notable, right? Because it suggests that analysts still see some near-term impact from the conflict, but they aren't forecasting a significant earnings decline, right? Now, in contrast, the second and third and fourth quarter estimates all have continued to trend higher over the same period. So that slope, the upward slope says, hey, markets expect the impact of the conflict to be contained and temporary, an indication that analysts are projecting earnings growth in the back of the year. So the key takeaway is the recent market decline reflects a valuation adjustment, not a fundamental deterioration. Earnings estimates continue to rise. Companies are beating expectations and profit margins remain healthy. Now, the market is pricing in some uncertainty around oil prices, inflation, and the path of Fed policy, but it's not pricing in a recession or an earnings contraction. Now, over the next couple of weeks, we'll see, right? Because second quarter or first quarter earnings season it started this week. And we saw some major banks come out with some good numbers. So we'll see. Really what we want to see is what the guidance is for, going forward for these companies. So if companies maintain their expectations for the back of half of the year, the current pullback could suggest the market is trading at a discount to earnings potential. If guidance turns cautious, the earnings estimates on the right may need to come down some more. But again, what we're seeing from earnings, what we're seeing from analysts is that it's not a deterioration in corporate fundamentals. All right. So looking ahead, what are kind of some of the key themes that we're going to continue to watch, right? The first theme, and it really is the most important, is this U.S.-Iran conflict and the impact on oil prices. So, like I said, it's, the conflict has sent oil prices from 60s to over 100. We're seeing them around 88 now, with the Strait of Hormuz effectively closed to commercial shipping. And that strait, handles roughly 20% of global oil flows. So again, like I said earlier, it's the most significant oil supply disruption we've seen in decades. The key question is, how long will this last? If the conflict's resolved quickly and oil prices start to normalize, the economic impact will be limited. If it persists and energy costs could weigh on consumer spending, corporate margins, and inflation. So the trajectory of the conflict will influence nearly every other theme that we've discussed in this webinar. As the second theme, as Sean discussed, is really an ongoing debate around this AI disruption. The software industry has declined about 30% from October peak as investors kind of reassessed which businesses are vulnerable to AI models and tools. The sell-off extended again beyond software, like I said earlier, into real estate services, logistics, and other sectors before stabilizing in late February. The core question is whether AI will enhance existing businesses or disrupt their business models entirely. And the market is still working out that answer, and we'll be monitoring releases of new AI models. So this theme could be a source of volatility as more AI tools are released and companies start to develop their responses. All good companies evolve, right? Microsoft was just a software company. Microsoft is not just a software company anymore. Now, there are companies that didn't evolve, right? We could talk about Eastman Kodak. You can talk about BlackBerry. I mean, BlackBerry had the world. Everyone had a BlackBerry. and they didn't evolve, right? So this is going to be important to see. This might come down the specific companies and how they evolve and embrace AI, because AI is not going away. And the third theme, and it's a theme that we've been kind of talking about, I feel like for the past 2 years, is Fed reserve policy, right? The Fed held interest rates steady at both its January and March meetings after cutting 3 times in late 2025. And the market was expecting 3 rate cuts this year, but it has repriced that dramatically due to this conflict. Due to the conflict, the rising oil costs, and the threat of inflation. So the key question is whether oil-driven inflation pressures are temporary or more persistent. So the next Fed move will depend on how the conflict evolves and whether energy costs pass through to broader inflation and whether the labor market holds up during this period of broader inflation. So this answer will have direct implications on borrowing rates, borrowing costs, and the broader economy. We did see rates come down here recently, and last week, mortgage rates came down as well. So it'll be, these are things that we're continuing to watch and we'll continue to take into consideration in your portfolios. So I will pause here and see if you have, let me go to this slide. Pause here and see if you have any questions. There's a hand button or something. Or let's see, there's someone here. Let's see. Good evening. All right. There's a button down the bottom of your screen that says chat. You jump in there, ask a question. We'll take a shot at answering it for you. I know we weren't that thorough. Some people have to have questions. We have one client who's not on the phone or not on the call here. He's always got questions, but he's not on today. All right. Well, all right. So let's wrap up tonight. I want to bring everyone back to the key takeaways, right? First, while the headlines feel volatile, from geopolitical events to market rotation, what we're seeing underneath the market, it's still being driven by fundamentals, earnings growth, economic activity, and interest rate expectations, right? So companies are still growing earnings. People are still spending money. I think we saw, last year the theme was tariffs and what it could be doing to inflation. Well, we see goods inflation came down. Services inflation is still being a little stickier. That really wasn't affected by tariffs. That's more a domestic problem. We're starting to see rents stabilize a little bit more. Hopefully that'll drive. Again, oil prices could drive up inflation. It could be short term. It could be more persistent. So it's something we're going to keep watching for. But, and what I always tell everyone, sometimes the headlines disconnect from reality, right? Right now, we saw it from the credit spreads. There's no credit deterioration. We see earnings. There's no earnings deterioration. The headlines are creating the volatility right now. Second, environments like this are exactly why diversification and disciplined portfolio construction matter. As we've seen this quarter, not all parts of your portfolio will move the same way. And having a well-structured portfolio helps navigate those shifts. So Sean showed you a slide where software was down 30%, the tech index was down 9%, but the equal weighted S&P 500 was up 1%, right? So that's kind of why we shifted from growth to value last year, and we might shift back from value to growth at some point this year, maybe in the second half of the year. But again, diversification matters in your portfolio. And lastly, our focus always remains unchanged. We're here to proactively manage your portfolios, to help you filter out the noise, to help you not get emotional, and position you for long-term success. Everything we do is through that lens. So just remember our 4 rules. Have a plan. Don't get emotional. Understand taxes, understand fees. And most importantly, I want to thank all of you again. On behalf of Island Park Private Wealth, we truly appreciate the trust you have in us. And we appreciate your time tonight. And we'll continue to take every opportunity to work with you and to earn your trust every day. But again, your trust in us means a lot to us. And of course, if you have any questions, just one more time, take a look, see if there's any hands. If you have any questions and you want to ask us after the call, please go right ahead. Don't hesitate to reach out. We're always here to talk to you and talk anything through on your mind. But thanks again for joining us tonight, and we'll talk to you all soon. Thank you.